I would be more worried about the yield curve, the US yield curve steepening rather than the inversion. We already know the yield curve in a lot of countries have been inverted, especially in the US, continues to be deeply inverted at levels of 2008 and 2001. Now, you know, a steepening here, especially with the new information we're getting now that the Fed is looking to pivot, the Fed is looking to pivot. A lot of the markets keep on coming into the equity markets. A lot of traders are coming in, buying dips, anticipating that the Fed's going to cut all of a sudden. Anticipating that next year we're probably going to see that Fed pivot or that Fed cut. Maybe we'll see it, maybe not. But a Fed cut, a Fed pivot, in my opinion, would not be the right thing for the markets. And the yield curve steepening is what I want to see. Maybe this is what we need. Maybe we need the yield curve to steepen here by getting the Fed pivot, by the markets getting bullish all of a sudden, maybe seeing a 30% rise from where we are right now in NASDAQ, and then getting sidetracked without knowing what is to come from all this tightening that we have done. Now, a steepening in the yield curve, don't think that's a good thing. Don't think that a steepening in the yield curve is a good thing. Although the yield curve, a healthy yield curve, healthy market does look like a steepening curve. It does. It's an unhealthy market would be inverted, which we are right now. But a steepening would mean that you're causing the short end of the bond curve. You're causing rate cuts to happen. So the short end of the bond curve, the yields there would drop, which would cause an inverted yield curve. If I were to put a line down here, cause this curve. So let's say this is the 2-year and this is the 30-year. It'll cause the 2-year to drop. And we're talking about yields here, not the prices, the percentage yields. Cause the yields to drop because of the rate cuts. And could we see the 30-year yields drop too? Sure, if that happens. But it wouldn't drop as much as the 2-year, which would then order it back into a steepening. So an inverted to then a steepening, right? Especially if the 30-year yields do drop. Now, I find it a little bit difficult on the 30-year for it to drop, because if we're cutting rates now and nothing has broken, then basically traders should be pricing in higher inflation to come. And if higher inflation is to come, then the yields on the 30-year should move up, while the 2-year yields are moving down on rate cuts. So the steepening would actually be exacerbated and stronger, would steepen more, because you got rate cuts bringing the 2-year down, the yields, and then higher inflation expectations, seeing the yields there move up, causing the yield curve to steepen. And probably if the 30-year bonds continue to dip more, sell off more, while the yields are pushing up higher, what does that mean for the UK pension funds? What does that mean for Japan? What does that mean for US? For a lot of these big economies, big countries that have a lot of debt in the longer end and are affected by these yields moving up higher, it could bring in a lot more bankruptcies, a lot more margin calls, a lot more sell-offs in the financial sector. It could cause something to just simply break and explode, especially since we got a little bit of a taste in the UK. And definitely Europe and UK would be definitely at a very difficult scenario, if that were to happen, if you get the yields continue to push up, if the Italian bond yields also on the long end continue to push up. Now, sorry, I'm getting um, into countries, into areas that that have maybe not so much relation with the Federal Reserve. They are all tied together, but when you do see the Federal Reserve start to cut rates, it starts to influence a lot of the other countries as well to start to do something in that same nature. Especially when you see Bank of Canada start to do somewhat of a dovish rate hike, you'll start to see a lot of the central banks move in that direction. And if they do, then yes, Europe, UK, Japan, right, Canada, US, Australia, if they all start to move in the same direction, what does that mean for their yield curve? Again, the yields coming down, pricing in higher inflation, steepening, higher yields. Imagine Italian bonds on the long end, those yields skyrocket. On the UK as well, skyrocket. It will definitely cause a lot of pain for institutions, for pension funds, for the whole financial sector to maybe implode, right? I'm not saying that the US financial sector is going to implode. I'm not saying that it's going to happen any second here, any minute now. But definitely it does create cause of concern. Definitely, something to keep an eye on if this continues to be exacerbated. So the yield curve steepening is what I want to watch out for and keep an eye on rather than the inversion, because the steepening will tell me more about what is to come than the inversion. Leave a comment below, let me know what you guys think, and subscribe, hit the like button as well, hit the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.